And I'm Edward Harrison.
And today on this very special episode of Boom Bust, we're focusing on a huge topic, none other than central banking. It doesn't get much bigger than that, Ed. And we're going to take a look at the institutions that oversee and manage the money supply, banking systems, and the currencies of the largest economies in the world.
And we've invited 4 guests to help break it down for us.
Absolutely. So first up, we have Mr. Peter Schiff. Peter is the CEO of Euro-Pacific Capital, chairman of Schiff Gold, and host of the Peter Schiff Show. Next, we have one of my favorite guys around, Mr. Marshall Auerback. He's coming to us from New York, and Marshall is Director of Institutional Partnerships at the Institute for New Economic Thinking, and he's also a research fellow with Economists for Peace and Security. And also we have Richard Ebeling. Now, Ebeling is coming to us from Baltimore, and he's the former president of the Foundation for Economic Education, the author of Political Economy, Public Policy, and Monetary Economics, Ludwig van Mises and the Austrian Tradition. And rounding out this very esteemed group, we have Mark Weisbrot. Now, Weisbrot is the co-director of the Center for Economics and Policy Research and author of Failed: What the Experts Got Wrong About the Global Economy. Good title. Good title, Mark. Now, I want to start off by saying, on Wednesday, March 18th, the Federal Reserve announced that it was dropping the word patient from its policy planning vernacular. Now, this opened the door for the central bank to raise short-term interest rates by mid-year, but they aren't ready just yet to walk through that door. Now, we've got lots to discuss, so let's not waste any time and get right to it. Ed, you want to fire off the first question here?
I do. I want to ask Marshall. Marshall, the Federal Reserve met very recently and decided to remove the word patient from its policy statement, signaling it could raise rates at any time from June forward. My question to you is, why should the average person care if the Fed raises rates? And, I mean, what impact does the Federal Reserve have on ordinary lives?
I think the impact, to answer the second part, that the Fed has on ordinary lives is rather overstated, and I don't think really most people should care that a little bit of verbal legerdemain is being taken out of the Fed statement. I actually celebrate the fact that the Fed is going to stop mollycoddling the banks and foreshadowing every single move that they make. In terms of the impact, well, I guess the obvious one will be on interest rates that are weighted toward, or structures that are weighted towards the interest rate increases. So mortgages would be one obvious area, and housing is an important area of the economy. But the reality is that we don't really know what the impact will be. This is an unprecedented experiment, and that the Fed has undertaken over the last few years. And the reality is that for every borrower that might be hurt by the increase in rates, there is a saver on the other side who will benefit. So I've always felt that the impact of monetary policy in general is overstated, and it's very diffuse and unpredictable. And I've always thought fiscal policy in that regard is much more germane.
Peter, I want to direct the next question at you. First of all, do you agree with Marshall and what he's saying? And would a rate hike at this particular time be a good thing?
Well, first of all, I don't think that what the Fed has done is unprecedented. I think history is littered with nations that have been destroyed by the type of monetary policy that we're pursuing. But I think the Fed needs to raise interest rates badly. They should have raised them years ago. But the reason they won't raise them is because they don't want to pop the bubble that they inflated. We don't have a real recovery. Thanks to the Federal Reserve, we have a gigantic bubble. The Fed has prevented a recovery from taking place, and so they've never intended to raise rates. The problem is economies work best under a free market, not centrally planned economies. But we have turned over interest rates to central planners, and they make huge mistakes, predictably. And now we stand on the precipice, I believe, of a worse financial crisis than the one we had in 2008, thanks to the actions of the Federal Reserve.
Well, Richard, Janet Yellen mentioned in her last press conference that equity prices were in the normal range, she said, by most conventional measures, if somewhat elevated, as if to say the monetary policy of the Fed had been just fine in terms of financial stability. So, Richard, do you agree with that?
No, I don't. I think you have to understand, and this is part of what I think Peter was just saying, is that we do not have a normal and market-based functioning financial market arrangement. The fact is that the Federal Reserve has been manipulating interest rates for years now. They created the previous bubble that became a burst, and they've continued to expand the money supply through their quantitative easing, until in fact what we have is a situation in which we don't have a price system in the financial markets in the normal sense. If you push interest rates through monetary manipulation down to zero, and you keep it there for years, where is the price mechanism to tell us what people's real savings are in the economy and what a market-based profitable investment is when you can't compare the possible profit with any real market-based interest rate reflecting resources set aside to sustain investment? As far as the Federal Reserve raising interest rates, it shouldn't be either raising interest rates or lowering interest rates. It should be allowing markets to set interest rates precisely so we can find out what is the real scarcity of savings in the economy, so the market and investors can adjust to that to keep investment in step with savings and not cause the imbalances and distortions that inevitably will create another bust once this boom has ended.
Now, Mark, I want to direct this question at you and all of the panelists. Remember, this is a discussion, so if you feel fired up, feel free to weigh in. We love to hear that. I'm looking at you, Peter, obviously. We love a lively debate. But, you know, Mark, I want to ask you, why do you think the Fed has resisted hiking interest rates?
Well, you know, let's step back from the ideological arguments and just look at what the Fed does when it raises interest rates, Now, all economists know this, but the public doesn't. And I think we'd have a different policy, and we'd have a whole different country if everybody knew that when the Fed raises interest rates, what they're actually doing intentionally is slowing the economy and throwing people out of work. And the idea is to throw enough people out of work so as to put downward pressure on wages, to keep wages from rising, or to slow down the rise in wages if they are rising. And that's what they do. Now, the rationale is that they have to do this to bring down inflation. But if everybody knew this was what the Fed was doing, I think you'd have a very different situation. And that's what's going on. That's why they're reluctant to do it, because, first of all, wages have been stagnant or declining for the vast majority of the labor force since 1979. So that is why we have such terrible inequality. That is why we have, for the first 3 years of this current recovery, 91% of the income gains went to the top 1%. That's not the whole reason, but that's a big part of it. Most people get their money from wages and salaries. So this Fed policy is huge. Central bank policy is huge all over the world. It has enormous impact on employment. And that is why the Fed is reluctant and should be reluctant to raise interest rates, because most Americans still haven't benefited from this recovery. Median household income is down about 3% since the recession ended in the middle of 2009. That's really no good for the vast majority of people.
Well, what about the markets here? I mean, Marshall, as Janet Yellen held her press conference at the Fed's Open Market Committee, the statement that they released, she said both equity and bond markets reacted by rallying to what she was saying, as if to say the Fed is not going to raise rates soon. Do you think that the equity market is prepared for rate hikes?
You know, it's hard to say. I've given up trying to guess what the equity markets are interpreting or what they, because as I think a few of the other panelists have suggested, we do have a financial bubble in the making, and you know, when the numbers look bad, that's considered to be bullish because it means that the Fed will hold off increasing interest rates. When the economy has some good numbers, that's also considered positive because it means the economy is recovering and we're going to have higher earnings. So, I mean, it's a whole bunch of gobbledygook as far as I'm concerned. And the broader question, though, I think that Mark discussed is the most relevant. Who's gained from the boom in the equity and in capital markets in general over the last 5 years? It certainly hasn't been the average American. And I think the Fed has been complicit in effectively trying to restore the status quo ante that got us into this mess in the first place in 2008. So in that sense, I think they are worthy of a lot of criticism.
Peter, you know, the U.S. dollar, it seems to be signaling the opposite of equity and bond markets, given how much the dollar has appreciated. Now, we all know this, but do you think the simultaneous rise in the U.S. dollar and U.S. asset markets simply reflects the influx of money into the U.S.?
Well, it certainly reflects the opinion, which I think is completely wrong, that the U.S. is enjoying a legitimate recovery rather than a bubble, and the expectation that the Federal Reserve is going to be raising interest rates. Neither of those expectations are true. We don't have a real recovery. It is a bubble, and the last thing the Fed is going to do is prick it intentionally. I think we're going to have quantitative easing for QE4. That's around the corner. The Fed doesn't want to admit that because it would be very destructive to actually admit the predicament. So it wants to pretend that everything is okay, that it's intending to raise interest rates at some point in the future, even though it knows that its next policy is going to be another round of quantitative easing. So I think the currency speculators who are betting incorrectly on the U.S. economy and on a tighter monetary policy, I think they're going to lose a lot of money, and ultimately the dollar is going to collapse. And certainly the U.S. stock markets have been the beneficiary of a lot of foreign safe haven money because investors in U.S. stocks have also enjoyed the gains of the U.S. dollar when they look at their returns in their respective currencies. But when the dollar starts to head south, that will also undermine the real return on U.S. stocks, and I think there could be a lot of selling coming from abroad.
Well, let's look at this from abroad in that case then. Richard, do you think the strong dollar will create stress on other countries due to the U.S. dollar's role as a reserve currency?
Well, I think that a lot of countries in the world, including the European Union, Japan, they prefer to have a strong U.S. dollar right now because that means, obversely, that their currencies are weak. And they suffer from this illusion that you can have a permanent prosperity by having a weak currency to stimulate your exports. The fallacy of that is that the only way they can keep their currency weak is to have a loose monetary policy in their own country, which threatens worsening price inflation for themselves down the road. And at the same time, by having a weak currency that temporarily feeds exports, they make all imports far more expensive, both for their own consumers as well as the manufacturers who import raw materials and various component parts for their own manufacturing. And of course, now you start seeing a competition between it. The European Union, the European Central Bank lowers its rates. And what does the Swedish Central Bank do? They turn their interest rate into a negative rate. In the 1930s, this was called beggar thy neighbor, trying to stimulate your own economy through exports. But when everybody does it, it leads to overall disaster for the entire global economy.
You know, Richard, I'm glad that you bring up
people.
Go ahead, please, Peter. Go ahead. Jump in there.
Yeah, people also overlook that exporting is a means to an end. You only export to pay for your imports. And when you debase your currency, you make it harder. You make your imports more expensive, and now you have to work harder to be able to afford them. What you really want as a society is a strengthening currency that enhances your purchasing power, that enriches your people. That's how standards of living grow. It's when you can produce more stuff, and therefore the price of stuff comes down, and your consumers can afford to buy more things because their money is more valuable and costs go down. But you have all these governments working at odds with that type of progress.
Peter, I'm sorry to cut you off, but we have to go to break right now. But when we come back, you need to stick around because our amazing panelists, they aren't going anywhere, and we'll be discussing regulation. Yeah, exciting stuff. So stick around.
Hello world, my name is Miguel Francis. I'm a film school graduate from Los Angeles, California.
Help! Help!
This huge piece of land called the Russian Federation decided to occupy this territory and then annex it from Ukraine.
Help!
For my first film project, I decided to risk my life, go in there and find out the truth behind Crimea.
Oh my God! Occupants!
Right from the scene. First-rate news and eye-gripping pictures. On our reporters' Twitter and Instagram. To be in the know, follow us online.
I know CNN, MSNBC, and Fox News have taken some knocks lately, but the fact is I admire their commitment to cover all sides of a story, just in case one of them happens to be accurate.
That was funny, but it's closer to the truth than you might think. Because when politicians and the mainstream media work side by side, the joke is actually on you. At RT News, we have a different approach. LOL. Because the news of the world just is not this funny.
I'm not laughing, damn it, I'm not laughing.
You guys stick to the jokes, we'll handle the news.
On the back of an election victory, Benjamin Netanyahu is posed to become Israel's longest-serving prime minister. What will his legacy be? A talented politician who polarized society, isolated Israel in the world, and refused to make peace with the Palestinians.
Welcome back to the show. Now, before we continue our discussion, let's quickly take a look at how a little-known committee in Washington, D.C. has changed the rules for regulation at the New York Fed. Boom Bust producer Bianca Fascini tells us more.
Last week marked the first time Fed Governor Daniel Tarullo exercised new regulatory power at the Federal Reserve when announcing the stress test results for major U.S. banks. As a result of the 2008 crisis, the Fed decided to create the Large Institutions Supervision Coordinating Committee, which was outlined in a paper known as the Triangle Document. Although it was written 5 years ago, the paper was not disclosed of until recently. As the Wall Street Journal put it, Washington is now in charge of bank supervision, similar to the way the State Department manages embassies. Prior to the adjustments made, the New York Fed enjoyed more regulation freedom. Instead of Wall Street banks being managed by the New York Fed, Tarullo and his committee will be in charge of them. New York Fed officials also no longer participate in policy meetings in Washington like they used to. The committee claims more centralized control would benefit all banks within the system by allowing the Fed to gain a more comprehensive assessment of risk. They also argue basing the bank examiners at the New York Fed instead of at the banks will help eliminate any leniency between examiners and bankers. In a statement, New York Fed President William Dudley expressed support for the move, saying he believes in a more integrated Federal Reserve System approach and called it an important part of our effort to ensure effective supervision of the nation's largest financial institutions. Though Fed Chair Janet Yellen also gave her support, this ultimately means more work for officials in both New York and Washington. In Washington, Bianca Fascini, RT.
Now, on the subject of regulation, we'd like to play our panelists here a quick clip by one of the more vocal proponents of Fed regulation. So take a look at this, guys.
I rise today in opposition to secrecy, in opposition to the veil of secrecy that closes the money changing that takes place in the temple of the Federal Reserve. While the money changes hands, the moneyed class gets richer and the middle class gets shortchanged.
Now, that was Rand Paul talking about audit the Fed legislation, obviously. And I'm going to direct this one to you first, Richard. What do you think about audit the Fed legislation? Good, bad? What are your thoughts on it?
Well, the fact is that the Federal Reserve is a government agency. It was chartered by the Congress. The Board of Governors are appointed by nominated by the President and approved by the Senate. It's a government agency, regardless of how they technically try to present it. And a government agency, therefore, should have a degree of transparency to inform the public and the country as a whole as to what it's doing and how it does it in terms of its portfolio and other activities. But of course, the fundamental problem here is, in fact, the central bank itself. And that is that the central bank is monetary central planning. the president nominates a board of governors who then become the monetary central planners of the country. It's presumed that these handful of people have the knowledge, wisdom, and ability to know how much money should be in the economy, what interest rates should be, what the value of the currency, both domestically and internationally, should be, as opposed to the more reasonable approach of having a market-based monetary system, a private competitive banking system in which the supplies and demands of consumers and producers, users of currency, savers and investors wishing to interact could determine interest rates, the degrees of risk, the types of risk, the type of financial institutions that they want to use, rather than one size fits all through a comprehensive system of government control through the Federal Reserve and other regulatory agencies. That's the fundamental problem.
Now, Marshall, let's assume for a second that the Federal Reserve should actually exist at all. Given the fact that it does exist and that you're saying that it should exist, do you think that actually centralizing control in Washington under Dan Tarullo is a good thing?
Well, I happen to like Dan Tarullo, and I think he's one of the few people at the Fed who hasn't become prone to regulatory capture. So I'm very sympathetic to the moves he's made. He's made life considerably less comfortable for Wall Street than, say, Tim Geithner did when he was at Treasury or at the New York Fed, or indeed the New York Fed in general, which I think has tended to mollycoddle Wall Street for far too long. So I do agree, but I also think that you have a broader problem, which is that you have a very, very complex financial system. It's overly, our economy in general is overly financialized. And I think I would like to see finance downside because regulation, Andy Haldane at the Bank of England has made this point that you've got a very complex financial system, and as a result of that, you have regulators struggling to keep pace with the extent of the financial innovation that's being undertaken by the banks. And so the problem becomes that you have an ever more cumbersome regulatory structure on top of an ever more cumbersome banking structure. And I would like to see the banking structure simplified, and therefore you could simplify the regulatory structure. And I don't see any signs of that occurring, and I think that's bound to be a problem. There's a certain hubris attached to the premise. As Richard said, I happen to agree that it's ridiculous to think that a handful of central bank governors can be the best arbiter of risks. I think this is a problem that Hayek made as well a few decades ago. But that said, I don't think the markets themselves have done a great job. And if you're going to go for a market-based system, which I think many in Richard's camp would go for, then I think you would have to also allow these banks to go bust in addition to so that you could have the proper pricing signals being sent to them. Now we're a long way from having that sort of a debate, but I think that if you're going to be consistently arguing that libertarian line, you've got to take it all the way through. Otherwise, I think you go for a much more simplified type of banking system like we had between the 1930s and the 1970s.
Mark, I want to direct this next question to you. Instead of relying primarily on regulation to do the job, why can't the risk-taking that financial institutions take be absorbed via higher capital requirements, such that losses, the losses, they basically tame institutions without having to worry about bailouts. Essentially, higher capital requirements let the institutions themselves suffer the brunt of, the burden they're gonna face.
Well, yeah, I think that's a good idea. I also agree with Marshall, though, that the financial sector is way too large and doesn't serve its basic purpose anymore, which is supposed to be to channel, as financial intermediaries, to channel savings to productive investment. It's just become huge. It was a huge force in bringing about two of our two last recessions were caused by the bursting of asset bubbles, and they played a huge role in that. And so, yeah, we need all of these things. But I also think that Fed policy itself is really essential. And I mean, we can debate, whether we want to go back to the 19th century where, before the Fed, where we had, depressions and much more instability in the economy and crashes and You know, but I don't think that's really worth it. I think we have a central bank like every country that I know of in the world, and it does set monetary policy. And the question is it going to set monetary policy that allows employment, full employment, like we had briefly in 2000, for example? We had 4% unemployment. And are we going to allow that to happen? Or is the Fed going to allow wages to grow? And, you know, because when unemployment is high, you know, wages don't grow as much. And the differential is very large, for example, both in unemployment and wage growth. So you have African Americans have twice the unemployment rate as the rest of the labor force right now and typically. And people in the bottom 20%, their wages grow much less than the rest of the income distribution when unemployment is higher. So inequality is directly related to Fed policy and how much the Fed allows the economy to move towards full employment. And that is really big. And I have to say, to the Fed's credit, they have changed. You know, 20 years ago, when Alan Blinder was vice chair of the Fed, and he had the nerve to say that the Fed had a mandate to promote employment and not just to control prices, the media came down so hard on him that he had to take it back. Now it's accepted. So we need to move forward from here. And that's why it's important that the Fed doesn't choke off this recovery.
Well, you know, I can tell that Peter's getting... he wants to get in there.
Can I just chime in?
Yeah.
Ed, can I just chime in very quickly? Let me just make a quick point, and then I'll give it the chair to Peter. On the question of capital buffers, not a bad idea, but I would rather capital buffers are a response to a pre-existing problem. So I say get rid of the activity that creates the need for the capital buffers in the first place. And on the question of regulation, I agree with much of what Mark said, but I would say go further and say I actually think the institution that's done best on banking regulation in the U.S. over the last several decades has been the FDIC. And my choice post-2008 would have been to shift the burden of regulation away from the Fed and put it in the FDIC, where I think people like Sheila Bair and Tom Hoenig have historically done a much better job than, say, Ben Bernanke and the current Fed has done. Now, Peter, I'm sorry to interrupt you. Go over to you.
Peter, I just want to tell you we have 30 seconds. Well, sorry, we got to get out hard, but we want to hear what you have to say.
Well, I can't say it in 30 seconds. Do we have another segment?
We sure do. You know, we aren't going to go anywhere. So, you know what? You hold your thought. We'll get you, and we'll give you the appropriate time. Thank you, Peter. I like it. And he's a director as well. What doesn't Peter Schiff do? That's all the time we have for now. But please stick around if you want to see more of this amazing panel and what Peter Schiff has to say. Also, check us out on Facebook, YouTube, you know, all that stuff. And please tweet at us at Aaron8, at Edward NH. From all of us here at Boom Bust, thank you so much for watching. Check you next time. Bye-bye.